Okay. Got it. Just share my screen. We'll start in 1 minute. Okie dokie. They come through all clear there. Isaac, can you just give me the thumbs up?
Yes.
Okay, great. All right, welcome everyone. I'm going to set a land speed record. We've got 15 minutes to get through how to buy your first home without family help. It is not a safari suit I'm wearing. Thanks for the positive feedback, but we'll whip through it. There's a bit to get through. So it's a disclaimer here. Of course, it's general advice. Please seek personal financial assistance based on your circumstances. So we're here to help. General advice, just give you an overview on purchasing your first home without family assistance. It's the award-winning team. Isa, head of broking, Sally, senior credit manager, doing the loan reviews. Win, our super loan processor, Ron Lacoste, partner in the business. Today's webinar is brought to you by the Key Choice Group. We've got two divisions. One is 80 Metrics Property Investment Negotiation Solutions about buying property, and of course Key Choice Lending, established 2003. How'd that get in there? Australian Broker Award. So we won in 2024, finalists in 2025, and now the Australian Broking Awards. We're up for Independent Office of the Year to be announced next month. That's why you should listen to us. That's what I'm going to say. So we'll start off with the basics of lending. So the 5 C's of credit. And this is don't worry too much. You'll get a copy of this after the webinar. You can scribble notes if you like, but it's really just a general introduction. So these are what's called the 5 C's of credit, and we'll go through them in more detail. But capacity, you heard of that as borrowing capacity, no doubt. Character, it's just your credit report. Capital, it's your contribution. Collateral is the security property. And conditions just means market conditions. So we can see here in this example, we've got this person, they've got great capital. That means their contribution is great. So on the left-hand side, we can see $2 million. If it was just based on capital, they could borrow up to $2 million. But as their serviceability or borrowing capacity is down at $1 million, that is the maximum they could purchase for the 1 mil, not the 2 mil. So they go on sort of the lowest of the C. So don't stress about a lot of words here, but we're going to start with your credit report. We'll go to the next screen because we've got a lot to get through. But your credit report is also called your character, and we've got Walter White there and Skylar from Breaking Bad. It was funny, Walter White was the drug maker and dealer, and Skylar was the wife, and she was the most hated character. But character essentially is your credit report. So we've got a thing called comprehensive credit reporting now, and what that means is the banks, when they're assessing your loan, will do a credit check. Reach out to us, we can provide one for you, but essentially it tells them whether you've been paying your bills on time. If you've got a good credit report, that'll reflect that your bills are paid on time, there hasn't been late payments, that you haven't had any defaults, so you've been warned time and time again. Everyone has a late payment now and again, but if the institution, whether it be a bank for any sort of loan or your water rates or your electricity bill, and they reach out, and you don't make contact, they can put a default against your name. So that severely impacts your credit score. And so the comprehensive part of it means that in the days, the left hand couldn't see what the right hand was doing, but these days your whole credit history is on file. So make sure that if you're having trouble paying your bill, you reach out to those institutions, get on the front foot, and it shouldn't affect your credit score. So they fall into different categories. Poor means it'll be, if you have a poor credit score, it'll be very difficult because you haven't got a proven track record of paying your credit facilities on time or your bills on time. Makes it very difficult. If it's fair, you've got a few late payments, you're going to have some options. If it's good or excellent, you're going to have many more options. So the next C is conditions. So best example recently is COVID. We've got during that time, if you worked in the travel industry or retail, hospitality, it was really difficult to get finance because, of course, your income's a big part of the way of how you're going to repay the loan. So if there's exceptional conditions, you may struggle in some industries. It's not often the case. So the first two, if you've paid your bills on time, so your character, and the second part, if it's everyday conditions like it is at the moment, if it bleeds, it leads. Of course, there's always bad news in the news cycle, but essentially those two, you should be fine. Two of the five C's ticked. The third C, collateral, I have some, not the most flattering photo of me. So collateral is a security property that you're going to buy. So the bank's not interested in doing any work to your property. They're a sausage factory. So what they want is you to have a home that's an apartment home, house and land package, unit or townhouse. Because if you move out, someone else will move in there. There's an undersupply of property at the moment in Australia. So it's going to be very easily, someone else will take your place if you're unable to pay and needed to sell. So they lean more against these type of properties. Big tick. What's a no is partially completed homes, and we're talking about specifically first home buyers here. So that there is lending for some of these things, but it's not your standard lending. Commercial properties, relocatable homes, warehouses, farms, things like that is a no. So the other thing we're looking at is, have you saved any other money? So this webinar, we're talking about you haven't got parental assistance. Have you been saving money? Do you have a car? I'm sure it's not a Lambo, but you know what I mean. Have you got some furniture? Have you got a boat, trailer? What other things have you got? So if you're 25 purchasing your first home, you might have less. If you're 45 purchasing your first home, you've got nothing. You spend your money all the time, no other assets, then there's going to be some questions asked. So capacity, this is what most people focus on. So we've got Harry and Meghan there. Their borrowing capacity plummeted when they left the royal family. Harry, although they did make a lot of money when they went on the world tour, saying they didn't want any media. They wanted to be left in peace. But anyway, that's another story. So C is borrowing capacity. As we touched on earlier in the webinar, it's not everything, but it is a big part. The bank wants to know how you're going to repay the loan. They're not interested, despite the media, in putting you into a situation where there's going to be hardship. So how do they assess that? So they want to see regular income, and they want to understand income less your current ongoing expenses and a living expense. So what does that leave you with? And that can be used for servicing of a loan. So do you have a steady job? What's a salary? What other loan payments? Do you have a car loan, etc.? Do you have credit cards? How many people in your household? Is it just you, or is it you and a wife or partner or kids, or the ongoing household makeup? How much do you spend on groceries, transport, etc.? So what's favourable is banks like PAYG, self-employed, if you've been self-employed 2 years or more. There's some exceptions to that, but essentially they want to see consistency of income. if you've got experience in an industry and have just changed, so you've been 10 years in working in hospitality, and then you've got a new job in hospitality, same similar sort of role, or you've gone self-employed and are contracting to in the hospitality industry to your former employer, things like that make sense. So that's favorable capacity. But if it's a big change, you've gone from flipping pizzas to running your own sort of gyms, running franchise from scratch, etc., that's going to be more challenging. So experience in the industry, consistent and ongoing casual or temp work. It's okay to work casual or temporary, but they want to see over 12 months, what's that look like for you, so they can average out the peaks and the troughs. And overtime and casual and bonus income, they take a percentage of that, generally 80%. So capacity unfavorable if you've been less than 2 years self-employed, besides those exceptions we've spoken about, less than 12 months casually employed, it's hard for them to understand the consistency of your income. If you're on JobKeeper payments, foreign income, work in a family business without the proper paperwork, or on probation, huge fluctuating income, super income, pensions, work cover. So all of these, there's exceptions to every rule, of course, come and speak to us. So can you increase your borrowing capacity? Yes. So you do that by reducing any existing credit limits. Of course, don't run out and do that now. Speak to us first. Getting rid of any surplus credit cards, reducing credit limits, closing Afterpay, their poison, limit non-essential spending, maybe cut back to going out 6 times a week instead of 7. Don't open any new credit facilities, i.e. car loans, etc. So next, we're going to give you an example here of just what borrowing capacity may look like. Of course, come to us and we'll do your capacity. But this Mr. Dog Breath, he is a single applicant, no kids, 95,000, lucky fella. His living expenses, got no loans. He spends $250 a month on media, $1,200 food and groceries, and you can see there. So he spends $2,225 a month. His borrowing capacity varies, as you can see, with the lenders, but essentially it's above 500,000 in those circumstances. The second example is he's married to Mrs. Dog Breath. They've got 2 kids. They're both on 95,000. What does that mean? Well, the borrowing capacity goes up. You can see, from 900 to $1 million. So it is more challenging for single applicants to purchase a property. It's just a reality that there's economies of scale with a couple of people in the house and greater income. This example, same example, but I just wanted to show you what the difference is when they've got a car loan. So they've got a car loan, 25,000, 12% interest, 700 a month for payments. Well, and of course you won't remember the previous figures, but it's about $100,000 difference in their borrowing capacity, just having that one liability. So it does make a big difference. So contribution. So the challenge is that you chose your parents poorly in this case, and that means that they are not going to gift you a heap of money. So what does that mean? How do you save for a home? So there's some first-home buyer incentives. They are limited. They're trying to get you into your first home, not into a mansion, but you can get some stamp duty concessions, first homeowners grant if you build new. Everyone says, oh, what's the first homeowners grant? But there are a number of different incentives for first homeowners. And there's what's called the first home buyer deposit scheme. So these vary from state to state. We're not going to go through every state in detail, but we'll give you an overview. So I'll put in here what would happen if you had a parental guarantee. So in this example, the bank only wants to lend you 80% of the value of a home without you incurring a risk fee called mortgage insurance fee. In this example, though, this is a parental guarantee, but why I'm showing you it is there's called the first home buyers deposit scheme. And so essentially in this example, purchasing for $740,000 in Victoria. The bank would lend 80% of the value of the property, which is $560,000 against the home. The person was up for, they get a concession on stamp duty, but because it's over $600,000 in Victoria, it's not 100%. It's still it's $40,000. So in Victoria, $600,000 you pay zero stamp duty, and it tiers up to $750,000. Then you're paying 100% at $750,000. Anyway, a lot of figures. All we're saying is first home buyer buying in Victoria, $700,000, $40,000 in stamp duty. The bank will lend 80% against the value of the home. In this example, the person has $35,000 in savings, and they need $145,000 to complete the purchase. That totals the $740,000, which is purchase price plus costs. In this example, lucky person has a parent's home they can use as security, but if you don't have that, the banks, some of the banks, unfortunately, participate in a first home buyer scheme, and it means that essentially, instead of you using parents' house, the government will guarantee that portion, exactly the same structure. They don't own any of your home. It's different. There's some schemes out there that they own a percentage of your property. This isn't it. And it's a great way to get into your property, because on this example, it probably costs you about $30,000 in this risk fee, mortgage insurance fee, if you weren't eligible for the first home buyer deposit scheme. Now, of course, there's some limitations, state-based, income-based, etc., purchase price. So I just wanted to give you an example. Let's say you were going to buy for $1 million, and we're talking about this risk fee, this mortgage insurance fee, and how much is that? So if you're purchasing for $1 million and you've got some deposit, but not quite enough to meet that 80% threshold, and I've just thrown in because there's different stamp duties, etc., in different states, but if you're buying in New South Wales and you needed to borrow 80%, 85% to complete the purchase, they will add on a once-off fee of $10,119. This is an estimate. Again, they change between banks, so just a back of envelope. In Victoria at $85,000, you've got $7,800. In New South Wales, if you went to 90%, $21,000 in mortgage insurance. Victoria, $13,600, and up to 95% they'll lend you, but you'll pay a really high risk fee, $41,000, $25,600. It doesn't protect you, it doesn't help you. All it does help you. It helps you get into your first home. It's just at an additional cost. The challenge being, historically, with properties going up in value, maybe doubling 10 years, 12 years, roughly, it's very difficult to continue to save and catch up. Living expenses being what they are. So oftentimes you're better off to get in sooner rather than later, because let's say a $1 million home, if it goes up by 8%, is worth $1,080,000 the next year. Are you going to save 80,000 in that year? It's very difficult. It's a challenge. So bigger deposit, the better, but sometimes you can be chasing your tail when going in. So a whole lot of words. Don't worry too much about it. Probably, gone over time again. Going to get rage baited out there. So just quickly, first home buyer assistance scheme, it's called New South Wales. You can purchase up to 800,000. In Victoria, they've got a stamp duty concession, no stamp duty if you pay up to 600,000, purchase for under 600,000. They've also got the home buyer scheme. What I'm trying to illustrate here is state by state, there's varying different benefits. So it depends where you are, how much deposit you got, and we can work through it with you. So South Australia, so we've got a matrix, we can send it through to you, but again, probably best to book in for a meeting and we can go through your circumstances. So Here we're again the mortgage insurance thing. This is a Victorian property. If you are under the first home buyer deposit scheme and you're buying up to 600,000, you really need 5% genuine savings, 5% of the purchase price. It's 600,000. That's 30,000 genuinely saved, which means over 3 months or more. But in this case, they've got 35,000, which is good because there's no stamp duty transfer of land, but there's a few other government fees and you'll need a conveyancer. So you need that room. But in this case, they've only got 35,000 savings, but they can buy a home for 600,000, pay 0 stamp duty and no mortgage insurance and get in their first home. If they weren't a first home buyer, you would see there that the stamp duty is $31,070. They would have to then pay a mortgage insurance fee of $23,000. So you've got, in the same example, but someone who's already purchased a home, they need 90,000 as a minimum contribution to get into their first home. There's been some changes for next home buyers recently. So come and talk to us about that if you're in this webinar, but you're a next home buyer. There has been some changes, but essentially massive difference, 35,000 compared to 90,000. Which type of loan is right for me? Don't worry about that now. Essentially, you've got variable rate, which is flexible, goes up and down with the Reserve Bank, and a fixed rate, which is locked in, but there's some consequences if you try and break those fees, those loans. Next step, QR code, please scan it, book in with us to have a chat about your own circumstances. Thank you. Don't grab this information and run it. It's changing all the time. So please reach out. We don't bite. The girls might bite. I don't bite. Yeah, don't use any of this information to run off and make a decision. We need to understand your personalised circumstances. That's it. Do we have any questions? Sorry for racing through things like that. It's 23 minutes. I'm well over and will be, no doubt, told what for. Anything? Yes, great shirt. Good idea to wear something very white on a stark black background with a pasty face. Yep. Nothing. What wonderful content. Terrific. Thank you. Nothing. All right. I'll leave it there. You've got our details. Please reach out if we can help in any way at all. Really appreciate you investing the time. If it's not now, we can help you plan for the future and what you may need to do to get into your property. Thanks, people. Have a great day and bye for now.